Hello and welcome to the Charter Hall Direct Insight Series. I'm Steve Bennett and I'm the CEO of the Direct business here at Charter Hall. I'd first like to begin by acknowledging the traditional custodians of the land on which we each gather today and pay my respects to the elders past and present. And thank you all for joining me for this update on Charter Hall and our Direct suite of funds for the June 2024 quarter. In today's webinar, we'll be providing an overview of what has transpired over the last 12 months in the Australian commercial property market and also provide a summary of the funds at 30 June 2024. Clearly, the past 24 months have been challenging for commercial property, both in Australia and around the world. We've witnessed the fastest increase in interest rates in Australian history and the highest interest rate level in more than a decade. This has caused asset devaluations, increased the cost of debt, and ultimately impacted investment returns across the market. As both the manager and a co-investor in our funds, Charter Hall has been navigating these challenges alongside our investors. We remain focused on actively managing our portfolio to preserve value for our investors as best as we can and setting the foundations for the next growth cycle. And with more than 30 years managing Australian real estate, Charter Hall has successfully navigated multiple property cycles before. And a downswing always leads to a slowdown in growth activity and a repricing of assets. We remain focused on well-located, high-quality assets that have strong tenants. This is reflected in the fund occupancy rates across the total suite being 97% or higher. However, these attributes have not made us immune to the impacts of the cycle. Based on the current data available, it's becoming clear that in most property sectors, devaluations are stabilising, which does suggest that we're approaching the bottom of this cycle. The recovery will likely be gradual and investor patience will be critical, but we do believe that we're well positioned for growth once this cycle turns. The senior leadership team, including myself, have learnt lessons from previous cycles. This will enable us to position our funds so that they deliver outperformance as the market moves into its next phase. And many of you are long-term investors, and I want to take this moment to thank you. It's a responsibility that we take seriously, and through our co-investments in our open funds, our objectives are aligned. I'd also like to remind you that we're not able to provide financial advice. Today's information is an update on our funds and the external market. And if you have any queries that relate to your own personal investment situation, we always encourage you to consult your financial advisor and to make sure you've read the product disclosure statements or information memorandums in full. Today, I'll be providing an overview of what has happened over the last 12 months in the Australian commercial property market. You'll then hear from some of Charter Hall's executive team, who will each provide an overview of their respective commercial property sectors. Then, I'll hand over to our fund manager, Julian Menegazzo, who'll give you an update on our Direct suite of funds and run through the key strategic focus areas for the 12 months and long term. So before we hear from any of our guest speakers, I'll take a few moments to give you an update and set the scene on what's happened in the last 12 to 24 months. Well, if you look at some of the media headlines over calendar year 2023, they were very negative around working from home, office valuations, and the elevated level of interest rates. Fast forward to recent commentary post the 30 June valuation period at 2024, and now many commentators are expecting that some of the property sectors have already reached bottoms, and if a particular sector hasn't yet troughed, it's getting very close to that point. So let's see it in a little bit more detail. What you can see on this chart up here on the screen is what's called the MSCI benchmark returns. It's an aggregation of all the core sectors being office, industrial and logistics, retail and diversified. And what can clearly be seen here, other than the small dip in COVID which rapidly recovered, this current downturn since the peak in June 22 is the most prolonged downturn we've witnessed in 15 years. So whilst the underlying conditions are very different to what was witnessed in the GFC, gearing is appropriate, the tenants are strong, the asset quality is up there. What has got similarities is the significant downturn in valuations. And breaking this out in a little bit more detail, you can see the underlying sectors. The red representing retail, the orange being industrial and logistics, and the blue being office. In what won't be a surprise to many of our viewers today, the office market has been most challenged in terms of valuations. And as I said in the introduction, whilst our occupancy and tenant profile is strong, we can't push back on the valuation cycle. What I can tell you is that the go-forward returns are looking as attractive as we've seen in a long time. And whilst you'll never know the very bottom of the cycle until you have the benefit of 2020 hindsight, many commentators are saying that they expect 2024 to be the trough year. You'll now hear from members of the Charter Hall executive team, Richard Stacker, Carmel Hourigan and Ben Ellis, who each gave an overview of their respective commercial property sectors at a recent property forum. They are responsible for a combined value of more than $50 billion of real estate across Australia.
There's a lot of information on this slide, but what it does summarise is the key drivers for I&L or industrial logistics demand, the key secular trends that will continue to drive that demand and thematic for the sector over the next decade. But it also shows you just clearly some property stats on the right-hand side there and how it's positioned currently in terms of occupancy, what we've seen in rental growth, what we've also seen in terms of actual capitalisation rate expansion. But also on the bottom right-hand side there, it's showing you the long-term returns over 15 years. Industrial and logistics has performed very strongly with about 11% total return. And the right-hand figure, that 7% is showing the volatility of that return, which is very, very low on global standards. And in terms of that total return, Australia has been one of the highest performing industrial and logistics market over that time. I am going to spend a bit of time now more on the left-hand side of that chart, talking you through some of those key drivers that we've seen and some of those secular trends. Population growth has been obviously a big driver for not just the Australian economy, but also for industrial and logistics. If you look at every additional person coming into this country, they're buying things. And ultimately those things that they're buying need to be stored, or generally are stored in a warehouse before they go to store, or they're delivered direct to their door. So for every additional person, that's about 4 square metres per person. And when you look forward to the population growth forecast, it's close to another 8 million square metres of space that'll be needed. And if you then look at that on top of what we've seen in online retail growth, which has been very, very strong, obviously through the COVID period, it has slowed down post-COVID, but that has also contributed to what has been a very strong demand driver for industrial and logistics. It'd be fair to say, and I think all of us have experienced this, me as well, that through COVID, not being a big user of online prior to that, I became a real user through necessity. What has been interesting through that experience during COVID is it was probably somewhat mixed. And I think most of us were fairly patient through it, given what we were experiencing. But that patience probably has started to wear thin with some retailers, and delivery and online growth did slow over the last 18 months. But what has happened through that period of time is retailers have improved their experience, both their website experience in buying, but too the delivery side is becoming a lot stronger. And part of that has been the Amazon effect. We've definitely seen Amazon come into this country and make a real shift in the service levels that people are experiencing when they purchase online. Just looking very quickly at a couple of slides here on the market. The one thing I would say is the vacancy rate in Australia for industrial and logistics has been very, very low, just over 1%, and has moved up slightly over the last 12 months to 2%, but that is well below equilibrium levels, which is closer to 5%, where you would say it's more a landlord and tenant market. You know, to that end, demand has been driven mainly through what we have seen, obviously with population, people buying online. But looking forward, although demand has slowed down a little bit with the economy, we'd still expect it to be very strong over the medium to long term with those secular trends that I talked about. We've seen very, very strong rental growth, not just in the last 12 months, but over the last 10 years for industrial and logistics. Close to 15% in the last 12 months, depending on the market. And over the last 10 years, it's averaged about 5% across our national market. So very, very strong for rental growth. The one other thing I'd say, just looking forward, is with very much a focus by our investors on what they would call beds and sheds, so residential and industrial and logistics, we do see a good opportunity in the medium to long term for investors to access our kind of product. There is strong demand for it, and that will drive future returns along with our tenant customers.
We obviously have seen significant change in office markets, and importantly, I think tenant customers' preferences around the globe. So today what I'd like to do is really touch on the main themes shaping and impacting office markets, why we believe high quality, well-located office will continue to perform coming out of what has been a significant correction in valuations. So there are a number of key themes which are shaping these preferences and demand for space. And I think the first one, which is so important, is not all office is the same. The most dominant theme globally since the pandemic is this bifurcation of office assets by quality. High quality, well-located assets have attracted the bulk of tenant customer demand, while secondary older stock continues to be under pressure and facing accelerated obsolescence. And more than ever, it's been very critical for Charter Hall to be a very active manager and divest those assets which simply will not perform in the future and are becoming uncompetitive. The second thing is, part of this preference for higher quality is also due to the requirement by tenant customers for enhanced amenity and wellbeing facilities. And that's all about attracting top talent and bringing employees back to the office. And this desire for additional amenity and facilities has accelerated obsolescence again in secondary stock that simply cannot provide it with intense capital to be invested, and maybe not even then. ESG and decarbonisation and the requirement for corporates to meet legislated targets over the next decade is driving both investors and tenant customers to seek the highest environmental rated assets. And we're seeing this across the public sector, government, and also private sector customers. All of the large investors around the world are now requiring strict criteria and standards in this space before investing. Electrification, 100% renewable power, waste and water management, energy efficiency are daily issues we face in developing new and managing existing assets. And this trend will continue to be a catalyst for tenants to seek new space, upgrading into better quality as older stock struggles. And finally, tenants are demanding the best in technology, services, and of course, cyber protection, with buildings needed to be future-proofed and run in a way that technology and apps are at their fingertips. So let's look at some of those drivers. So Australia has been in a virtuous cycle of strong population and employment data over the last 10 years, which has underpinned white-collar employment growth. And this slide illustrates annual jobs creation since 2013 through to June 24 and shows an average of around 270,000 people gaining employment. Solid migration numbers, particularly in skilled migration, which is very different from other parts of the world, although going forward we'll probably see less than what we've seen in the past, over the next 4 years, will further assist in promoting increased demand for office space. And at the same time, we have not seen a change in the amount of office space per person in office buildings, which I think is a really important point. If you couple this with leading population growth, we see a continuation of what we will think is sustainable demand for office accommodation. One of the frequent questions I'm getting at the moment is the impact of technology. So many have said that AI will be a negative for office markets. This slide shows you through time, you can see that despite all the advancement we've had, we've continued to see white-collar jobs growth. Technology makes companies more efficient, it improves margins, it makes them more profitable, they can expand. And so although we are now in a world of AI, we don't anticipate that this is going to have a significant negative impact on white-collar employment growth. In fact, some of the larger moves we've seen in the last 24 months in the Australian market have actually been from technology companies, Amazon, Atlassian, Salesforce, companies behind the growth in technology adoption. They see flexibility as critical, that's what they're selling, but the requirement for collaboration is equally important. And more we're seeing these companies demanding their staff back to the office to improve idea generation. And one of the best examples is Atlassian, who obviously committed to full flex for all their staff after the pandemic and committed to a 60,000 square metre tower in Sydney at Tech Central, and are now requiring people to come back to work as well. And Amazon is another example of that. So there is momentum, definitely momentum, and the stats are showing that in the back to office. And the next two slides are probably the full story in the office markets at the moment. This chart reflects the solid take-up in prime office space across Australian markets. And despite what you read in the media, the 10-year average of net absorption or net take-up of office space is around 290,000 square metres. And we're currently very close to that, which is an amazing stat when you stand back from it. It's a strong result, but in contrast, we're seeing a totally different story in secondary stock. So you compare this is where the real issues are happening. It's a reverse situation where we're seeing space being vacated, and we've now reached double the 10-year average. So 268,000 square metres being vacated on a rolling annual basis, which is a large reduction and shrinking in secondary. You really need to look through the headlines to see that there are two different markets at play. So prime's in the game at the moment and secondary is still on the bench. And a large part of the market, when people talk about total vacancy, is just not up to standard and will need significant capital, if even possible.
Today I have the pleasure of talking to you about retail and in particular the non-discretionary convenience retail sector, Charter Hall's preferred retail subsector. So whilst the slowing economy, weighed down by elevated interest rates, is likely to impact consumer spending, past cycles have shown us that impacted businesses are likely to be in the discretionary retail categories such as fashion, homewares, electronics, jewellery and furniture. These are retail sectors that we are not exposed to within Charter Hall's portfolio. The resilience of non-discretionary retail will remain, and we expect to see continued sales growth from our predominantly fresh food and essential retail service offerings. Put simply, everybody has to eat. They've got to feed their families. They've got to keep themselves and their loved ones healthy, and they've got to be able to turn up to work every day. Our assets at Charter Hall service these non-discretionary retailers. Increasing density in our metropolitan areas is resulting in higher revenue from our retailers, improving their performance and ability to pay annual rental increases without impacting their business profitability. Adding to this is a look forward lack of new retail supply. It is becoming increasingly difficult for Australia's major retailers to find new appropriate sites in metropolitan locations, given site values are more suited to higher density residential usages to help reduce Australia's well-documented housing crisis. This in turn drives increased retail in our existing retail network, and their sales will go forward as a result. One item often overlooked with convenience retail is the effective cash yield of the sector. Higher starting yields and lower incentives mean that the convenience retail sector generates a high passing yield, and as a result, it continues to attract more investors to the sector. Finally, it's pleasing to see that the convenience retail transaction market has continued to be buoyant, and it appears that valuations have stabilised. Once again, this reflects the resilient nature of the convenience retail sector and its consistent performance through most property cycles. I'll have a close look at a couple of these tenants and delve into them in some more detail. Australia's supermarket industry is highly concentrated with four major grocers: Woolworths, Coles, Aldi and Metcash, enjoying an 81% market share. This is incredibly high on a global standard, and it also shows and demonstrates the high barriers to entry that exist for any potential future competition. We've seen this play out more recently. In the last 5 years, Kaufland, one of Germany's biggest supermarket providers, tried unsuccessfully to enter the Australian market. This concentration has also protected Australian grocery retail from any material impacts of online retailing. Currently, Woolworths and Coles provide for 85% of all online grocery transactions in Australia. This represents about 10% of their annual sales, but most importantly, 85% of all their online orders are fulfilled out of their existing store network, reinforcing the importance of bricks and mortar retail and driving greater profitability from our shopping centres. Bunnings are a key part of the convenience retail sector. Beyond serving one of Australia's best sausage and white bread combinations, you've all had one, Bunnings provide convenient locations for the general public and Australia's trade people to buy essential tools and building materials. They are also a very strong business with consistent sales growth and increasing the size of their store network, but importantly, without impacting their very impressive EBIT margins of 12%, as you can see on this chart. Bunnings are a very profitable business. Charter Hall is Bunnings' largest cross-sector owner. We work collaboratively with them to both increase their store rollout as well as fulfil their logistics facility requirements across the country. Another key attraction of Bunnings to Charter Hall has also been the potential for long-term rental growth. Bunnings have been the predominant developer of their own stores and as such have focused on commencing their rents at a very low level. That means that strong rental reversion potential exists as we move into option periods, particularly given the high quality locations and land holdings that these stores possess. Bunnings rentals are now at or below industrial rental levels and well below large format retail levels and even further behind traditional retail rental levels. The quality of these locations also gives a landlord fantastic long-term higher and better use potential as conversion to residential. Could be to higher order retail offerings and even industrial usages where, as I've just noted, market rents are often above Bunnings passing rentals. It's a complicated chart, but it has a very clear understanding that where supply is reducing, and it's the same across all asset classes at the moment. Availability of suitable and appropriately zoned land in urban areas is becoming increasingly difficult to find, and where it can be found, typically the highest and best use of that land is for residential development to support our growing population. Ironically, this amplifies the need for our convenience retail assets. So this is an opportunity, as existing assets will outperform as population grows and densifies around them. The productivity of retailers in these assets will improve and therefore ability to grow the rental will follow. We're fortunate at Charter Hall to have the largest convenience retail team in the country with over 135 professionals working to unlock value and drive outperformance. Finally, investor demand for these assets is also increasing given the lack of supply, meaning the sector will continue to enjoy heightened liquidity, particularly as our tenant and asset performance remains not only resilient, but grows.
I'd now like to hand over to Julian Menegazzo, Fund Manager for the Direct business. He'll provide you with an update on the suite of funds.
Thank you, Steve. As a manager, we are focused on outcomes and items within our control. You can see up here on screen that we have achieved several outcomes over the past 12 months within leasing, occupancy and transactions. As a manager, we have completed over 110,000 square metres in leasing across the office and industrial sectors within the Direct suite of funds. These leasing outcomes have contributed to our market-leading occupancy rate of more than 97% across the funds and the portfolios. We successfully also completed $1.3 billion in transactions, and this included over $990 million of divestments in difficult market conditions. We have also recently completed our bottom-up budgeting process across the funds on distributions, and the outlook is that the distribution rates will be maintained into financial year 2025 across our Direct suite of funds. Whilst we can never guarantee external factors that might impact, we are confident that the distribution outlook and current distribution rates will be maintained. June 2024 marks 2 years since the property valuations were at their peak. Here, you can see the significant rise to the cash rate commencing in May 2022 at the historical low rate of 0.1%. The timing of these interest rate rises is consistent with when commercial property valuations peaked in June 2022. The rise in interest rates has been one of the main drivers to valuation movements over this period, with no commercial property sector being immune to the impact of interest rate rises. What this has caused is a shift in commercial property pricing, with buyers of commercial property seeking to acquire assets at lower prices across all sectors. And these factors have subsequently led to valuation declines across all commercial property sectors. I'll now take you through some of the key trends that we observed in the June valuation periods that we recently completed. With a portfolio across the broader Charter Hall business of over 1,600 assets, we gain valuable insights into the trends and how independent valuers are assessing valuations across all property sectors. Within the office sector, and despite transaction volumes being at historical low levels, sales evidence did increase over the first half of this year, and the sales evidence that occurred across the sector has unfortunately continued to negatively impact valuations. Office values across the market are now down between 20 and 30% since their peak values. This has impacted the entire sector, also including high quality office assets with where the majority of the Charter Hall portfolio sits. The impact has been dependent on the location, occupancy levels, tenant profile and overall quality of asset. Over to industrial, and the market fundamentals across the sector continue to remain positive. However, valuations still declined over this period. Industrial values across the market are now down by around 10% since their peak values, and this is around half of the overall impact than what has occurred in the office sector. Moving to retail, and valuations across this sector only had minor valuation declines or were relatively stable over this period. What does this mean for overall performance? Well, the 12-month performance to 30 June has certainly been a challenging period across most funds, and this is demonstrated up on screen with the 30 June unit prices and the 12-month fund performances across the direct suite of funds. Whilst there has been some positive performance above respective benchmarks, overall it has been a difficult 12-month period to navigate through. Unfortunately, the office sector in particular across DOF and PFA has been the most impacted over this period. On the right-hand side of the screen, this outlines the various MSCI benchmarks, and it is worth highlighting that the negative 12-month performance across the office fund benchmark sits at negative 16.4%, and this comprises a number of wholesale funds within the market. The individual funds within this benchmark have lower target gearing ranges and all had negative 12-month performance of between negative 12 to negative 25%. And these returns are not too dissimilar to DOF and PFA. However, DOF and PFA does have higher target gearing ranges. So what that means is with wholesale funds with lower target gearing ranges, they have been less impacted to overall valuation declines. As highlighted earlier, a number of independent property analysts are suggesting we are through the worst of the cycle and are now approaching the bottom of the property cycle across most market sectors. Here, we look at the longer term investment performance of the individual funds from their inception date or when the respective fund was launched. Pleasingly, over the long term, 8 of the 9 funds here on screen have continued to outperform their respective benchmarks, and this includes the 30 June valuation impacts. It's worth remembering that property is a cycle. The cycle will turn and property should be considered a long-term investment. I will now go into the individual funds, and the first fund I will cover today is DIF4. DIF4 is a sector-specific industrial fund, $3.1 billion in size, with over 56 directly owned assets across the industrial market. DIF4 provides investors access to a portfolio that is 100% occupied with long leases to high-quality tenants across all Australian major industrial markets. This fund has been successful in selling 8 small-scale assets over the last 12 months, where these assets were identified as non-core and we believe value was maximised. In terms of the fund's go-forward investment strategy, DIF4 is well positioned, with gearing below 40%, no major lease expiries approaching, and moving forward, the fund will be looking to take advantage of pricing opportunities and seek to acquire high-quality, high-yielding, long-leased assets across the industrial sector. The proceeds of the fund's recent sales have been used to reduce debt and position the fund to assess potential further acquisitions. ESG also continues to be a key focus from tenants across all sectors, and this is something we will continue to focus across new acquisitions and the existing DIF4 portfolio. LWF is a $331 million diversified portfolio across 15 directly owned assets, with exposure across a number of sectors, including industrial, social infrastructure, long WALE retail, and office, with the sector's percentages up on screen. The fund has a well-balanced diversified portfolio with an occupancy rate at close to 100% and a lease expiry profile of over 6 years. The fund pays distributions on a monthly basis. LWF does benefit from having a diversified investment strategy, and this is beneficial as the fund has the ability to tilt its sector allocations and can adapt to changing conditions in commercial property cycles. So the fund can acquire assets in high quality growth sectors. The growth strategy for LWF will be to position the fund to increase its exposure to the industrial, social infrastructure and long WALE retail sectors and selectively assess acquisition opportunities across these 3 sectors. Moving across now to the office funds, starting with the direct office fund. DOF is a $2.2 billion sector-specific office fund, and its investment strategy focuses on core CBD office markets. Despite the broader office sector challenges, the Charter Hall team remain extremely focused on items within our control. Maintaining the fund's 98% market-leading occupancy level and extending the lease expiry profile where we can of currently 6.1 years. We are in active discussions across a number of potential lease extensions, and if successful, this will further extend the fund's lease term. Over the course of financial year 2024, the fund has successfully contracted to sell over $350 million of assets identified as non-core. The proceeds of these sales will be utilised to reduce debt and prepare the fund for its major liquidity event approaching later this year. Despite the fund selling a number of assets, office sector transaction volumes do remain at historical low levels against long-term trends. We will communicate to DOF investors later in the year with more details around the major liquidity event. PFA is our other office fund, and this also benefits from a high occupancy rate of 98% across a $1.6 billion portfolio with a weighted average lease expiry profile of 5.4 years and 5-star sustainability rating. Similar to DOF, the management team remain laser focused on leasing and positioning the fund's assets within their respective markets to retain and attract tenants. High sustainability ratings are essential for office assets, particularly with government tenant exposure like within the PFA portfolio. And the government have got an increasing focus on sustainability in the buildings they occupy. Management continues to work through the fund's outstanding redemption requests and recently made a further payment to those redeeming investors. The fund's intention is to deliver full liquidity as soon as possible, subject to further asset sales being achieved, with a realistic expectation of redemption requests being delivered by the end of 2024. The strategy across DOF and PFA is similar, and we have been actively selling older assets across both portfolios. In financial year 2024, we successfully sold over $640 million across 8 assets. We assess these asset sales, you can see up on screen, in the context of the age of the asset, the future potential capital outlay across each of the assets, and tenant retention, and also the forward-looking return outlook across each asset. These sale proceeds were utilised for capital management purposes, including to reduce the respective funds' gearing levels and also pay redemptions in PFA. Although these funds are not actively acquiring assets and the entire office sector has been significantly impacted, we are focused on portfolio quality, maintaining market-leading occupancy levels and extending leases and continuing to increase the sustainability ratings across the portfolio. This approach will best position these funds for growth moving forward. Our Maxim fund has a different investment strategy to our other funds, as this invests in stocks traded on the ASX and provides investors with an exposure to high-quality real estate investment trusts across the country. Some of these real estate trusts continue to trade at material discounts to their valuations following the 30 June valuation cycle. In line with recent Australian equity market performance, Maxim delivered a total return of 22.5% in the 12 months to 30 June. As I mentioned earlier, this product is a little bit different as it does invest in listed stocks, and investors should understand the risks around this type of investment. The WPS series provides investors access to some of the highest quality assets across the market through Charter Hall's wholesale funds and partnerships. WPS1 is approaching its realisation period commencing in 2025. To take advantage of current pricing at cyclical lows, WPS2's investment period has recently been extended by a further 12 months to July 2025. This provides potential investors an opportunity to invest at a low point in the property cycle. You can see the fund allocation of WPS2 up on screen, and this provides investors exposure across office, industrial and logistics, long WALE retail, social infrastructure, and a small allocation to listed A-REITs. The final fund I will cover today is DIF3. The fund has provided investors with strong investment performance through the property cycle, and the outlook for industrial does remain positive. DIF3 has its review event approaching in September 24, and the fund is likely to roll for a further investment period and also offer investors liquidity for those seeking to exit. We'll be in contact with investors with more details over the quarter. I will now hand back to Steve, who will provide an overview of the Charter Hall Group and the outlook across the market. Thank you.
Thanks, Julian, and to our guest speakers today. I'll now just wrap up with a few concluding remarks. Charter Hall is the largest owner of real estate on behalf of our investors in Australia. We do understand that it is challenging times in terms of valuations, but we do also believe that our scale, depth and breadth of experience uniquely positions us to be able to navigate this current point. We are confident that with over 600 real estate professionals located throughout Australia where we own assets, that will be able to drive outperformance for our investors over the long term. That concludes our update for the June 2024 quarter. And thank you for taking the time to join us. If you have any questions or queries on something you've heard, please get in contact with our team whose contact details are up there on the screen. Thank you.